Good morning from our global headquarters in New York. I'm Menace Graney. Welcome to Bloomberg Brief. Let's set your agenda. Is a steady slowdown underway? The countdown begins to the U.S. jobs report. A mega deal in the works, Aramco's secondary stock offering, is set to raise at least $11 billion, making it the biggest deal in 3 years. Never-ending boom time. TSMC's monthly sales rise 30% as industries race to secure AI chips. A very good morning. Any sense of nervous exhaustion in these equity markets is well hidden. $4.6 billion flowed into equities, the 7th week of money flowing into equities. You've now got Microsoft, Nvidia and Apple worth more than the entire Chinese stock market. But the path of least resistance, according to Morgan Stanley Lisa Shallett, is one of a grind higher. The path of least resistance is higher. A couple of stocks to note. You've got GameStop at the bottom of your screen, up 34%. I mean, we're up just under 70% now in 2 days. Keith Gill will take to YouTube later on this evening. It's a must view for you. But these meme stocks, you cannot ignore them. Ignore them at your peril was Amy Wu Silverman's notification from RBC earlier in the week. TSMC, as we said, the May sales rose by 30%. Again, invigorating the overall chip narrative, the insatiable demand for chips. On the bond side, the bond bulls have been firmly in charge. We need a fairly soft number in the jobs report to spirit the yield lower again. Whisper number in the bond market, 165. Consensus is 180 in terms of the jobs report. It's going to be about a validation of this move lower in the bond market in yields if we get a softer number. And to the euro, the shorts have certainly trimmed their positions. We're back to 108.89. The ECB jacked up their inflation estimates, and Makhlouf, the Irish central banker, this morning saying, I don't know how fast the ECB will carry on, if at all, in terms of cut. Phlegmatic is how I would describe that board at the moment. There is only one event of the day. It's counting down to that payrolls report.
Looks like the labor market is cooling a bit, but it's moving into balance.
Until we see outright layoffs pick up in earnest, which is not where I believe we'll be, or even in the next couple of months, until we see that, the market has room to run.
We may see a little bit of a bounce back from weak April. But the labor market is slowing.
I think the bar for bad labor market data for the Fed to be cutting sooner than the market is pricing is pretty low. We think we're going to see 140,000 payrolls, which is a further slowing.
If we get a payrolls number close to 160, that could actually be the Goldilocks print that we need.
This is really a lot of cross currents, and I don't think that the Fed's going to have it figured out in the next week.
Well, Frank, Monkam is our guest this morning, Senior Portfolio Manager over at Antimo. And he writes this: Inflation Street is way too slippery. The only viable path to cut City is via the jobs road. Crucial NFP print today, and that is ahead of the Fed and the CPI. Frank, good morning. Good to see you.
Morning, man. It's happy to be here today on Jobs Friday.
Absolutely. It's going to take a heck of a soft number to really deliver momentum, more downside in terms of this yield. So suddenly the dual mandate will be the reason, the employment numbers will be the reason that we see the real possibility of a cut this year.
No, absolutely. I like to kind of contextualize the current macro backdrop a little bit just to get a sense of how crucial this, jobs report is today. We've seen a slew of data this week, from PMI, ISMs, JOLTS, ADP.
Everything.
And we get central banks from, the other side of the pond starting to cut rates with the ECB, the BOC. But, the main event still is the jobs report today. And the reason being, there's just not enough, runway for the Fed here from an inflation perspective to get to target before the end of the year for these two cuts to materialize. So we're going to have to see a pretty significant deterioration in the jobs market for the Fed to move here. That is pretty clear.
But do you really see that? I mean, we're trying to run the numbers. I mean, they need a heck of a series of good numbers on the inflation side, on the disinflation side. On the jobs numbers, we've run some numbers. We're going to need to see jobs unemployment at around 4 1/8 on a 3-month average before you would call the technicalities of a recession. Again, that's a pretty high bar, Frank.
Yeah, that's a pretty high bar. I think, the markets are looking, especially risk assets, are looking for a Goldilocks number about around 150K, more or less 10%. But anything below that, I think the threshold really for the Fed in terms of the bogey for the Fed to really start panicking and think about rate cuts here very rapidly between now and the end of the year is the 100K mark, right? And to your point about having to see a series of data before cutting, I totally agree with that. I mean, the Fed has been pretty adamant that they want to see a series of data. Same thing with inflation, right? We had three pretty hot prints early in the year, but the Fed didn't, just panic and start raising rates. So same thing with the jobs market, right? And if you think about the word series, mathematically speaking, it's you need at least 3 data points to be able to have a series, right? Because if I say to you 1 to complete the series, most people would say 3, but it could be 1 to 4, right?
Which would play to what Waller intimated in terms of wanting several more constructive inflation prints. Let's bring it back to the bond market. We rallied, we got 20 basis points. It's not what you call a furious rally, but it had momentum. You say cyclical positive convexity into a softening economy. I mean, my question to you is, what is it that breaks to the downside? What is it that you need to see in data to help the bond market break lower in yield?
I think it's going to have to be, like I said, major breakdown in labor market data.
And that's got to be around 100,000.
That's going to be 100,000 on the 3-month moving average.
ECB jacked up their inflation estimates for this year and for next year. Again, and at the end of the last show, we just heard from Christine Lagarde, where she talked about sticky inflation and she talked about a bumpy road. You have a tactical allocation to commodities because of this sticky inflation. Where exactly?
Well, the story of commodities now is slightly different. I think, the current macro backdrop still is favorable to an allocation for commodities, but I think investors need to make sure that they remain a little bit more nimble here and watch out for the different idiosyncrasies of commodities and the technicals around commodities. I think it's more of a story of being tactical and agile around some relative value plays. Within the commodities complex, say energy to metals RV plays, relative value that is. So we've seen recently, for instance, a lot of fund managers playing, copper against oil, right?
Yes.
So these are the types of plays that investors are going to have to, kind of be agile on, instead of just having a beta allocations to commodities where we are in the cycle today. So I think it's more around finding, if you have a stock picker mind, it's more about picking stocks here than buying the index, so to speak. So you want to be tactical around copper, gold, oil, and be respectful of the technicals. I mean, we've seen what happened, to crude oil here recently, where the market basically got derated, because of a sequence of bearish catalysts, and we are today with the market that's kind of almost max short, versus copper that's overstretched to the long side. So these are technicals that investors need to be watching as they allocate.
Do you think those pivot points come when you see that overstretch on the bear side in oil to the overstretch of the bull side on copper? You sort of dig a bit deeper into the technicals and you look for pivots.
Correct.
Lisa Charlotte over at Morgan Stanley, I think it was a fairly straightforward analysis. The path of least resistance is to grind higher. You look at, what was it I said? Microsoft, Nvidia, and Apple. The 3 stocks are bigger than the entire
Chinese stock market.
It's a pretty gargantuan statement. You warn of complacency in the equity market. Now, the last time you were with us, you were warning, look, there's a possibility of a drawdown. There's sort of nothing stopping the freight train of the Mag 7 at the moment. But talk to me about what you are basically talking, this complacency. How complacent are we? How fully invested are we? And what is it that worries you so in terms of positioning?
Yeah, so what I'm worried about is, this momentum, to your point, is very strong. That's undeniable. But I think there's a risk of this momentum kind of peaking here a little bit. Positioning is very overstretched. CTAs are max long. Asset managers are almost fully invested. 150 basis points in cash. That's near. It's almost a 10-year low here in terms of cash allocation. So I feel like the only thing that's supporting this market really is the hefty amount of buybacks programs that are still very active in the marketplace. So I think the market is being very, very complacent. If you look at vol and skew on the S&P, for instance, that's really, really cheap. So I think investors should be looking at, plays such as, buying, some cheap downside protection by buying some puts. Perhaps, you have at-the-money volatility on the 3-month basis on the S&P that's sitting at a 12-year low, right? So even if you're long the market, I think it's a pretty cheap insurance to add to your portfolio at the moment.
We're going to hear from Keith. I know that you're going to set your clock. I know you're going to be logged into YouTube later on this evening. I know you're going to make the strategic, tactical investment advice based on Keith Gill appearing on YouTube. I'm saying that with an ironic smile, but actually we shouldn't be smiling because Amy Silverman was with me from RBC on Tuesday, and she said, you know, do not decry what's going on with meme stocks, GameStop, AMC, she said, because it does have an impact. It does have a material impact for institutions. What are you and the rest of the team talking about? As we're covering, you know, there's GameStop, up 33% this morning, up 70-odd% over 2 days. I know these are violent small stock swings, but they have some kind of residual impact on psyche, don't they?
No, totally. And I think, you know, if you look at a lot of people that are running risk today, you know, say versus pre-pandemic, you know, everybody has to have the ability to model these things, right? Because investment psyche and behavior has changed a lot with sort of the gamification of investing. So we have to be respectful of that. There's still a wall of money out there that's, you know, sloshing around, that's going to, you know, continue to chase these type of opportunities with meme stocks. So
do you think it's just retail that's playing those stocks, or is there some kind of hint of institutional behind that as well?
Well, I think institutional players are looking for ways to exploit this market, right? But I think it's mainly retail driven, but you can't have a one-way market, right? There's got to be two players, and I think, you know, institutional investors are looking for ways to capitalize off of that.
Frank, let's see what the jobs number gives us. Whisper is at 165. Wish you well. Counting down to that number, Frank Monkam there of Antimo, our guest setting the agenda on Jobs Day in the USA. Stories trending on your Bloomberg terminal this Friday morning. China is said to be conducting comprehensive site inspections of its biggest mutual funds. The country's audit office sent a team of about a dozen staff, each to at least 10 of the top firms in the past weeks. The auditors screened through documents focusing on expenses. Japan's biggest banks are planning to sell $8.5 billion of Toyota shares. That's according to people with knowledge of the matter. The banks will sell in stages and take advantage of Toyota's buyback program to minimize the market impact. The NBA Commissioner, Adam Silver, says the league will turn to expansion, possibly overseas, after it completes a new round of TV deals. Las Vegas and Seattle are both looked at as favorites for new NBA franchises. Mexico City is also considered as a contender. The only foreign team presently is the Toronto Raptors. Coming up, Saudi Aramco is about to rake in more than $11 billion from its secondary issuance of Aramco stock. More on the story. And later this hour, we drumbeat to the payrolls report with Dana Peterson, Chief Economist of the Conference Board. Context matters on Bloomberg. It's Bloomberg Brief. I'm Menace Cranny in New York. Saudi Aramco is set to raise at least $11 billion from its secondary stock offering. That is the biggest deal globally in almost 3 years. Stephen Stuczynski joins me now. It's been a big week for this share sale into a falling oil market, with sentiment being challenged on multiple fronts. Stephen, good morning to you. The scale of this offering to foreign investors. You're in Singapore, I'm in New York. This was marketed in London, New York, and all over the world. How tough was it to bring this secondary offering this week at this time?
You know, I think from what our reporters were hearing, this had more overseas interest than the initial offering in 2019, I believe. And that could be for a number of reasons, right? I mean, one, clearly the picture for oil right now, the oil market right in front of us, is not terribly sunny, but Saudi Aramco is a pretty attractive company if you look at the money that they give out. If you look at their dividend, it's the largest in the world. They're going to give a $125 billion dividend this year. That's 5 times more than Microsoft, which would be the second in the world. So it did gain more interest globally. We don't have the exact breakdown, but that's what the reporters are hearing. So there was that interest there, certainly.
Let's just talk about the oil market. We've had, as Halima Croft called it, an aspirational taper, which His Royal Highness Prince Abdulaziz bin Salman has really actively come out and warned us, give it a day or two, reality will fall in. But, I mean, oil's down 3%. It's hardly what you call a taper tantrum, but we're still trying to understand this release back of barrels to the market later in the year, aren't we?
I think this is all a game of expectations, right? I think when you were reading the analyst reports a few weeks before the OPEC Plus meeting, there was this expectation that they would keep these curbs in place through at least the end of the year because things are softer, right? The Chinese demand has been a little bit soft. U.S. driving has gotten better, but overall the U.S. picture was also pretty soft. Shale drilling is more resilient than I think people were expecting at this time of year, at this price level. So overall, them coming out to say that they're going to be adding barrels to the market, I think about 500,000 barrels a day by the end of the year in the fourth quarter, and 1.8 million barrels a day around this time next year, was a bit of a surprise to some folks. And while Saudi Arabia certainly is saying that the market, they're just reading the market tea leaves, and they're keeping the balance, they're playing it there. Seeing prices fall to this level isn't something necessarily that their leaders want to see, especially if they want to balance their budget, and doing so requires Brent closer to $100.
It does. Not sub $80. That's certainly not what they need for the grand ambitions. I just wonder where the corridor is in oil prices to invoke the said pause. We got to wait and see. Stephen, thank you very much. Stephen Stavchinsky there on Aramco and the oil market. As I say, we're heading for the third week of losses after OPEC's supply plan rattled the market. RBC Chief Commodity Strategist Helima Croft says to find balances in the oil market, you have to look into sanctions. I caught up with Helima Croft at the RBC Global Energy Conference.
Where I think you want to look for potential, like, in terms of like balances to the market, like what changes, like in terms of like where you could see volumes come on, you have to look at sanctions, and you have to say, is there potentially a move? Because if you listen to statements by people like Jared Kushner, like they're basically saying like Iran could do what it did in terms of like having basically the the terrorist proxy groups all over the place because they have the cash, and so like you need to close the ATM. But the interesting question is, would you see a President Trump come in and be like, we're going back to zero, and we're going to aggressively enforce the sanctions? Because you can talk to people, we have it in our notes, people who had been in the previous administration would say, like, give me 6 months, I can get $1 million off. But the question is, with like rigorous enforcement. But the question is, would President Trump really want to take $1 million off in 6 months? As some officials, we put it in a note because they were indicating that's what they thought they could do. Would they do it without a backfill? And when you put this to like even more powerful people who would be potentially influencing Trump, they would say, well, yeah, we'd probably want a backfill. And the question is then, can you get, like, if you were going to squeeze Iran.
So where's the backfill come from?
The backfill would have to come from the Gulf countries. And the question is, after 2018, would they front run a production increase? And I would say that is the thing that I think that they are concerned about. Like, we might do gestures, but like, are we going to basically give you $1 million extra with your promise that you're going to take $1 million off? Or are you going to take $1 million off and we have a deficit in the market and then we'll backfill? I don't think we can expect after 2018 to have these countries be like, we'll take it on good faith that you are going to do this. So like, let's put those barrels.
They want a deal in Congress. They want.
They see that like we're not going to say we're going to enforce it. They want to see that like we're real about this.
RBC Chief Commodity Strategist Helima Croft speaking to me at the RBC Energy Conference in New York. Coming up in the show, I look at what else is making the headlines around the world. Is there anything else apart from Jobs Day in the USA? We'll reflect on some of the moves from the European Central Bank and check in on these markets ahead of the jobs report. What's making news on the front pages around the world? This is what we've got for you. First up, the New York Times. The Israeli Prime Minister Benjamin Netanyahu will address Congress July 24th. Netanyahu is facing intense criticism as Gaza war continues. Some Democrats, including the former Speaker, Nancy Pelosi, have said that they would boycott that address. Financial Times leads with the UK tycoon Mike Lynch. Remember this story? Acquitted of criminal charges by a jury in San Francisco. Lynch was accused of deceiving HP in paying $11 billion for his software startup company, Autonomy. And Bloomberg leads with the China export story, surging 7.6%. That beat the estimates, but imports missed, indicating weak domestic demand. Speaking about China, just check out the gold price, because, of course, we understand that they bought zero gold in May, and they had been on a rampage, buying gold furiously. Likewise, a lot of central banks had gold dips at 1.48%. Its peak was 24.50, and oil slips again as the market digests the release back from OPEC+. This is Bloomberg. From our global headquarters in New York, a very good morning. I'm Menace Cranley. Let's set your agenda. Is a steady slowdown underway? The countdown begins to the U.S. jobs report. A mega deal in the works. Aramco's secondary stock offering is set to raise at least $11 billion, making it the biggest deal in 3 years. And a never-ending boom time. TSMC's monthly sales rise 30%. As industries race to secure the AI chips for the future. A very good morning to you. Welcome to the show. It is Jobs Day, and so really there is the focus on the bond market. What have we got for you? Really today is about a validation of the narrative of the softer jolts, softer wages in the services report. BMO have a report out. 33% would sell any pop in yield. 54% are willing to buy any dip in yield. Is range trading. But the bottom line is the whisper number we're looking for 166,000 in jobs. Consensus is at 180. Stocks, is there a sense of nervous exhaustion? Not from the flow show. $4.6 billion flew into equities for 7th week in a row. And the path of least resistance, according to Lisa Shallett over at Morgan Stanley, is really a slow grind higher. Two stocks to watch. GameStop up 32%. Keith Gill will take to YouTube later today. We'll understand maybe some of his motivation in terms of trading these meme stocks. NVIDIA, Microsoft and OpenAI are, of course, all the customers of TSMC, which saw their sales rise by 30%. There you go, up 0.5%. So the stock narrative, there's no sense of nervous exhaustion there. The euro, the shorts have trimmed after a hawkish cut, one could say, from Christine Lagarde and her cohort at the European Central Bank. Monkam, the Irish central banker, says he doesn't know how fast the ECB will carry on, if at all. Again, reaffirming the narrative, this could be one and done from the ECB, or indeed just a hawkish hold. I managed to make that sound exciting, but everything's virtually unchanged. That's the job. Let's bring in Mike McKee. Let's make the jobs report. Countdown to the jobs report a bit more exciting. With bated breath, we wait. Mike, good morning to you. We were just having a private conversation about the whisper number, so let's continue that. 166,000. And what would you say to that whisper number relative to the median?
Well, the median has come down, but this is the first time in a long time that the whisper number has come in way below what the economist forecast is. The market's been above the forecast for many, many months now, and it has proved out. But overnight, we saw a drop in the economist forecast as more estimates came in to 180,000. It was 185 yesterday. Earlier in the week, 190. Hasn't changed anything in terms of the unemployment rate or the average hourly earnings. We have average weekly hours on there because if the economy is really slowing, we might see a change in there. And the warning here is that you're going to not want to react necessarily on the first headline that comes out, because May has a seasonal adjustment problem in that with all the teachers who go home at that point and all the kids that then go to work at the swimming pools and the daycare camps and things like that, the BLS has trouble matching those things up. And so the May numbers tend to come in a lot lower. So the possibility of a downside surprise for technical reasons is also there. So, Manus, we could see a change in the pattern that doesn't mean anything, or we could see one, depending on the distribution of this, that suggests that the economy is slowing significantly.
It's interesting, though, that the street has got nervous, incrementally more nervous as the week has gone on, as you say, from 190 to 185 to 180. But then I wonder how much of that is sort of like inside the bubble, and that's what drives this lower whisper number. Wages are important from the consumer point of view. 3.9%, Mike. Now, 3.9% again, if it comes in at that level, again, would reflect one of the slowest growths in 3 years. That's what we had in the previous month. So there is this evolution of slowdown in income.
Here's the problem with that. If we want to keep making this more exciting, which I know
I'll
you
take
do
any
at
level of
this hour of the
excitement.
morning, as the survey period this month for May ended on the 18th. It can end as early as the 12th. It includes the pay period that includes the 12th of the month, but the way the calendar fell, this one went past the 15th of the month, which when a lot of people get paid. So if people got raises, there are some economists out there who are looking at this and saying it wouldn't take much to move this up from a 3/10 forecast to a 4/10 forecast, and then maybe move wages up to 4%, just as a calendar quirk. So suppose we get a drop in jobs created, but a rise in wages. Then you're going to hear that stagflation word again as people panic, because what do you trade on there? That's the hard part. And the good thing to keep in mind is even if we fall to a significantly low number, 166, it's still well above the number the Fed considers neutral for the economy, which is about 100,000. Anything higher than that is a pretty good payrolls report, even though it won't seem like it because we've been so high for so long.
Okay, Mike, I'm sure you, Jonathan, and Lisa will make it exciting. We'll tune in at 8:30 for those numbers as they come through. Mike McKee. Joining me now is Dana Peterson, Chief Economist at the Conference Board. Dana, good to see you this morning. So the street is getting incrementally more nervous, 190 to 180. It's not a huge shift. And there's the confirmation bias in the whisper number. In other words, inside the clack, they're all howling for a lower number. Is this just a confirmation bias day? Is that what the market is baying for? It wants confirmation of a gradual slowdown.
Well, I think the thing that, Mike said is that anything above 100,000 is still a decent number, but it's all relative. And certainly the big numbers that we saw in payrolls over the last couple of years was catch up. And so many industries have already caught up in terms of adding all the workers that they lost during the pandemic. And really the big drivers are just a few industries that are still trying to catch up. But we did see last month that almost all the increases was in healthcare and social insurance. Meanwhile, leisure and hospitality and government really pulled back. So if we see that pullback again, and it's really only one industry driving things, then we're going to see a labor market that's probably kind of topped out in terms of payroll gains.
Well, if leisure and hospitality, as you say, do show some kinds of perhaps slowdown, again, this reflects back to the wages component. Many people have said, look, the growth in jobs has been at the lower end and the wages have been suppressed because the growth in jobs has been at the lower end. It's a bifurcated market. So what would you say to that if we do get a slowdown in those two sectors and how that might play out?
Well, I think, the opposite thing is happening with wages. Wages were really elevated when you couldn't find enough people to work. But now, like I said, a lot of industries have found workers, so they don't need to pay up as much to attract and retain workers. But even still, it's that inflation issue where wages are much higher relative to where they were on average between the great financial crisis and the pandemic. Mm-hmm. Wages were growing, under 3%, and now they're just under 4%. So that's still pretty high, and wages are still putting upward pressure on consumer prices, which is something that the Fed is very concerned about.
You have a baseline, I think, as the market has, which is that growth will continue to slow. We've certainly sort of seen that in some of the assessments. Growth will slow in the second half. Torsten Slok puts out his note and he talks about earnings, equity earnings will deliver the underbelly. Strong earnings will deliver high capex and higher fixed investment. That in some ways will help create a floor in growth. So what kind of slowdown do you think that we will get? And will that be commensurate with a more brutal unemployment situation, or will it just be a slow drift lower and very unlikely to crash to that 100,000 level of jobs created?
Sure. So the first thing is that earnings and what the stock market is doing doesn't reflect what the real economy is doing. The real economy has been slowing because consumers are pulling back. In the first quarter, consumers didn't buy any goods. And certainly the most that they're buying right now is services, and that could pull back, certainly as consumers are still complaining about price levels are very elevated, and interest rates are also elevated. So that eats into spending, as well as the fact that the excess savings is gone. And also consumers have racked up a lot of debt. So we do expect that the economy is going to be even slower in the second and third quarters. But in terms of the unemployment rate rising, that might tick up a little bit, but not much, because much of the data suggests, if you look at jobless claims and if you look at our CEO confidence measure, companies are not letting people go. They're holding on to workers because of many people retiring. So that's going to put a cap on how many people get let go, even as the economy slows.
Yesterday, we saw the ECB raise their estimates for inflation for this year and for next year. And again, reaffirming that global narrative that it's going to be a bumpy road. Inflation will be sticky. It's going to be hard to call. Frank Monkam was with me a little bit earlier, and he said, look, it's going to be tough. It's going to be bumpy. I mean, how sticky is this inflation for us with oil where it is at the moment, with the commodity pricing that we've got at the moment?
Sure. So when you look at goods, yes, energy is starting to contribute positively again to inflation, but it's very little. Most of the inflation is in services, and it's basically in three buckets. It's in the shelter costs, which are going to continue to slow, but it's going to take the rest of the year. It's insurance costs, and then there are wages, the upward wages pressures. And so the insurance costs, we don't know when that's going to ease. Insurance companies are saying it's very expensive to insure cars because they're high tech. And also it's very expensive to insure homes because of all the climate events. But when it comes to wages, as long as companies are willing to pay up to hold on to workers, then you're going to have those upward pressures. And those are things that the Fed can't necessarily control. The Fed is controlling the shelter issue, but it takes a long time. But it's those other elements that are going to be a challenge and probably keep inflation sticky and make that last mile of getting back to 2% a lengthy process.
Dana, you're down for one cut in the fourth quarter. How convicted are you on that? Or is that getting emboldened? I mean, the market has gone a little bit earlier, and maybe a coin toss for September. So how committed are you to one cut in December, or are you skewing to, Manus, actually, it could possibly rise to 2 this year?
Actually, we do have 2 cuts this year, November and December. And the thing is that even that's like a questionable issue, because if inflation doesn't continue to slow, and it stays where it is because of those upward pressures I mentioned that the Fed has limited control over, then we might not have any cuts this year. But we are optimistic that the Fed can squeeze in at least 50 basis points. But even with that, you're still going to have a federal funds rate that's, 5%. So that's still very elevated interest rates.
Still pretty much worthwhile to keep some money in cash, maybe, as opposed to some higher risk assets. But then it could be that slow grind higher on the equity side. Dana, we're counting down to those numbers. We'll both get more information as the morning goes on. So too will the market. Dana Peterson of the Conference Board, my guest this morning, counting down to the jobs report. Coming up, the chip frenzy continues. TSMC's sales rose 30% in May, driven by AI demand. It isn't slowing down. Context matters on Bloomberg. Good morning from New York. It is Bloomberg Brief. I'm Manus in New York. It is the world's largest chip maker. TSMC continues to benefit from that AI boom, seeing its May sales rise 30% to more than $7 billion. Let's bring in Tom McKenzie. Never far from a chip story. I mean, it's just the ferocity every day with which we report on these stories. What caused that spike, or is that the beginning of a new demand iteration? Tom?
Yeah, Manus, it's a combination of 2 things for TSMC, and that's why these earnings or these results in terms of sales are particularly interesting. So for the month of May, year on year, a 30% increase, again, for this contract manufacturer. Here are the 2 elements that are interesting. One is they're starting to see a rebound in terms of electronics demand. So look into that iPhone, for example. They produce the vast majority of Apple's iPhones. The other component, no big surprise here, is that continued demand for AI accelerators. TSMC is the foundry that manufactures NVIDIA's GPUs. No TSMC, no NVIDIA GPUs. It's as simple as that. They have that symbiotic relationship. So those two elements coming together for TSMC, leading to that pop in sales from the month of May, year on year. Look, year to date, TSMC is up about 50%. It's the fact that you're starting to see a bottoming out, arguably, of the smartphone part of the business in combination with the demand for AI accelerators that is leading to the optimism that you're starting to see around TSMC.
Listen, I'm all in on the next upgrade for AI on my iPhone. I'm all in there. I'd even probably pay money for it. There you go. Actually, I don't know that I'd pay money for the AI. I like to do my own research. OK, NVIDIA. The stock split is coming, and I've had a number of different guests come on, and it depends, pay your money, take your choice. Democratization of NVIDIA, it means many more people can buy it. That's a good thing. But with that democratization, Tom, comes volatility. So talk me through the stock split. It goes live. And what are you hearing in terms of vol on that?
Yeah, 10 for 1 is the stock split. It's not the first time they've done a stock split, but of course this comes on the back of those blowout earnings. Of course, they've beaten quarterly earnings 7 out of the last 8 times. Most recent earnings, a big beat. They come out then with this decision around the 10 for 1. The stock is what, 1,200 or thereabouts. They said that they want to make it easier to access for not just their employees, but of course investors. Yes, so there's a risk. There's a cost, obviously, of doing this, a small regulatory cost, a small legal cost they have to pay. And then there is a question about volatility. It doesn't change the fundamentals, of course, doesn't change the fact you're still going to be getting your dividend split by 10 if you're a shareholder. That, again, doesn't change the fundamentals of this business. There's some research that maybe on the back of a stock split you get a bit of a pop. Maybe that comes through. We'll get a print or price on that on Monday, of course. But look, for them, the rationale is they want to make sure this stock and this share is accessible to as broad a group as possible in an environment where, again, tripled in value last year, up, 145% so far year to date.
Is there anybody can really seriously challenge NVIDIA or AMD in the near term, or do they have this sort of splendid lead time of dominance?
It does seem to be a consensus when you speak to the analysts that they have this lead time. The demand stretches into 2025 now. The fact that the demand is outstripping supply for NVIDIA, and that is expected to continue into 2025. We know that AMD, we know that Intel are upping their investments to try and close the gap. But the gap is sizable, because don't forget, it's not just the chips, it's also the services component and the software component. And Jensen Huang, clearly, we got a reminder of that this week. He's not sitting on his laurels. He's come out with this annual upgrade cycle. And again, he's pushing not just in data centers, that provides about 70% of the revenues right now, but also into personal laptops, the enterprise component, the sovereign component. And it's a company with, 60% or so margin. The question is, expectations around the stock, are they so high that if you get a bit of a misstep in the next earnings, does that knock things too far? The competition is a story worth watching. Some of their main customers, Meta and Amazon, are building out their own competitive chips as well. So that is maybe a longer term story.
OK, Tom, thank you so much. Tom McKenzie there, tracking the tech stories of the day. To the oil market, it is a third week of losses as the OPEC plus supply plan rattles the market. This is the world's biggest producer, Aramco. It's set to rake in more than $11 billion in its mega stock offering today. There's the price of crude. Anthony DePaola joins me from Dubai. Anthony, good to see you. This was a tough couple of weeks to take Aramco, the secondary offering, to the market. There was competition domestically with some other IPOs. But talk me through the marketing of this and what was the message to global investors.
Yeah, good morning to you, Manna. So, yeah, it's a big week in Saudi Arabia because we did have that OPEC meeting there at the same time as this Aramco offering is going on by the Saudi government. And the real value proposition there is the dividend. I mean, they've got this massive dividend, $124 billion this year, and that's roughly $30 billion more than they paid out last year. So it's a big jump, and that's still that special dividend that they're paying out based on the bumper earnings of 2022. And they're talking about keeping that special dividend We don't know the level yet, but keeping some sort of a special dividend going forward in years coming forward. So they're really trying to attract investors in with that dividend. The shares do look a little bit expensive compared to other peers in the market. So that's one issue that investors will have to look at. And there's that issue of the reduced production in Saudi Arabia because they have to abide by those OPEC plus agreements. So really, shareholders are kind of asked to invest on the strength of that dividend, investing in a company that's not really able to produce as much oil as it could. So that's the issue. That big government overhang in terms of decisions on Saudi Aramco is one of those things that have kept investors skeptical about Saudi Aramco. But we have seen more international interest in this offer now than we did in the IPO, which was in 2019. So shareholders, investors rather, seem to be more used to that company now, Manus.
Yeah, to be fair, I mean, they had to price it at, what, 6% discount, and some of the other secondaries have gone at 10% discount, so they didn't have to throw it away. Briefly, is the market becoming more accepting of the release back? Just briefly, Anthony. I mean, Hilly McCroft called it an aspirational pause, is what OPEC Plus has said. They're going to release the barrels back, but they will hit the pause button if they really need to. Did that really get reaffirmed this week?
Yeah, I mean, I think that was the big message yesterday when the Saudi energy minister and the UAE energy ministers were both in St. Petersburg next to the Russian energy minister. So they really talked about the possibility of pausing that and not going ahead with that. So the market was already looking at this a little bit skeptically, doubtful as to whether there was the space to bring those barrels back. Now it's put up into question, you know, what will they do? Will they bring those back? Will they not? We'll have to see how the market is, Manus.
Okay, Anthony, thank you so much. Anthony DePaolo there in Dubai, tracking the oil stories. Coming up on the story, there is only one event that matters. It is the jobs report. Your whisper number at the moment stands at 166. It's a beautiful day. It's dawn in New York. It's Bloomberg Brief. I'm Menace Crenny in New York. Tune into YouTube. Keith Gill schedules his return on Friday. That is going to be a first that we haven't seen in 3 years. GameStop up 70-odd% over the past 2 days. DocuSign extending post-earnings decline amid weak guidance, and Robinhood extends its rally after announcing to buy the European crypto exchange Bitstamp. There is only one market that really dominates everything. It is the tail that literally wagged the proverbial dog, and that is the bond market of the United States of America. We're counting down to the jobs report. And there you go. 5 days down 20 basis points. You need to see something significantly below 166 to invoke a move lower. JP Morgan, Citi are the last stand saloon. They're going for a July rate cut. I applaud the optimists out there. Let's see what the job report gives you in terms of jobs, hours worked, and wages earned. And the survey at BMO says, sell a pop in yield. Good morning from New York.